right, everybody, welcome. It's Rob. Hope you're having a fantastic day. Welcome to Technical Trading with Robert Roy. What a day, what a day, what a day. As you're looking at my screen here, you can see the S&P 500, and we have had yet another interesting day. I want to spend a little bit of time from a technical standpoint talking about the market itself and what today, actually what the last 3 days, but particularly today, means for us. But the warning signs were kind of there, right? So we've had, when we look back on this Fibonacci level that I've drawn here, and that fib will extend back, and I'll give you some dates to make it easier. From November 21st is where the fib started. That's off our swing low. And we brought that up to our highest high at the time, which was December 11th, 12/11 of 2025. We had this nice pullback in there. If we look, we had a swing low here. So there was a low. And then we had put in our high. All right, we came down here. We put in a higher low and then a higher high. Higher low, higher high, higher low, higher high. And we played a little bit there. We failed a little. And then we violated again here. So we had a lower high and a lower low here. We gapped, so we moved back up, couldn't get to the highs again after this candle, and we gapped down. This was the Greenland, we're going to war, we're going to have all these tariffs on Europe, all that, what wound up being fake news there, come out on there, misinformation, I should say. And we had a great move to the downside, and that now gave us a lower low yet again. So indicating the move switching to this direction from bullish to bearish. Right, we took a nice little bounce off of there. Next day, the president came out and said, nope, we're all good. We're not going to send any troops. We're not going to do this, that, and the other. Whatever it was, the market rose, right? There was some Japan worries in that area as well. The market rose. We kicked up. We put in a new all-time high at that time, which was right here. This is on the 27th. And then we pulled back, and we got, again, a low, but it's higher low. You've got to compare the lows to the previous swing low. So we had our high right here, right? And we had a low here. From that, when we broke down, this gave us a lower low than the previous one was, right? We also had violated this one here. So we took another step to down towards the basement. As we moved up, we're targeting the high again, and we got through there right here. So we now had a higher high, higher high. Sorry for the mouse handwriting. My handwriting is horrible as it is. The mouse doesn't help any. We made a move down. It became a lower low. I'm sorry, it's a higher low because this was our low. This one doesn't count. Yeah, we violated it, but that's our low. That's the one we're worried about. If we're looking at a stair step, we're looking at it taking out the previous lows, not we vacillated a little bit over here and we bounced up or came down. Not that. We're looking to take out the low, the low, the low. That's what we're looking for, and higher, the highs, we're looking for lower highs as well. So now that we're all up to speed, what happened? I am a very big advocate that when you put in a low, you put in a high, you've got a Fibonacci line in place. They are, to some extent, a line in the sand. What does that mean? That's where support is for that level, for that stock, for that position, for this place in time. That doesn't mean we can't break it. Doesn't mean we won't break it. Doesn't even mean we'll ever touch it again. We may bounce before hitting that and never see that level again in history. We may just take off or gap right through it and never get back and touch it again. But as we made our move down on this day, so this is just a few days ago on the 3rd, on Tuesday, as we made our move down, we had the wick open up below the swing low that we had put in place. And for those that, if you've seen some of my previous trainings, a swing low looks like this. We had a low, a lower low, and a higher low. Body doesn't matter, how high, none of it matters. You had a low, a lower low, and a higher low. That's what designates a swing low. And it's flip it upside down for a swing high. That's all it is. You had a high, a higher high, and then a lower high. That gives you a swing high. So this was our swing low to contend with right now. We pierced through it right there. Yes, granted, we opened up near the high of the day, pushed up a little bit more, but not by very much. We fell down. We came back up and closed higher than we had stretched down to, which was wonderful, right? But this breaking of that swing low, the way that I describe it, I use this all the time in my teaching, is I want you to think of, someone's out there in the ice, and they're chipping away at the ice, and the tip of the hammer just breaks through, right? That's what happened right here. They were chipping away at the ice. Who? The bears chipped away at the ice on this day and broke through. And they basically said, look, you want to come in? Doors open, baby. Come on through, right? So what happened? The next day, we pushed even lower. Still did not close below it, but it doesn't matter. We're getting a lower low each day, and we are breaking that swing low level. Today, we gapped down and we opened down below there. Not only did we gap down and get below that on the open this time, we pierced through the next swing low. So when we're looking at, will our directional move hold weight? If you have a bullish move doing this, going up, as long as we're putting in higher highs and higher lows, higher high, higher low, higher high, higher low, and so forth. As long as we're doing that, we're good. As soon as we pull back and do this, and now we have a lower high, it is not an, oh my goodness, the world is coming to an end. My cell phone on days like today, days like yesterday, days like the day before, Tuesday, Wednesday, today, Thursday, my cell phone lights up regularly for this. From family members and friends reaching out saying the world's coming to an end, what do I do? From students that are in some of our trainings reaching out, other traders that I know, traders that are in my masterminds that I am part of, reaching out and say, what are your thoughts? What are you seeing out there? Individuals that are just investing in the market that are, relations to me, whether friends, family. I get all of these panic calls of what do we do? And what you basically have to do is follow the pattern the market is showing. So think about this. Let's have a conversation about this for a second. If you're looking at this right now, do you go into deep panic mode and go, oh my goodness, the world is coming to an end. I guess it's time to just give up, walk away, sell, just get out of everything, right? I got some good gains in there. I should lock them in. And I'm not saying you shouldn't lock in your gains, right? But you've got to ask yourself the question is, what would be the trigger point that says for you, I've had enough, I'm out. We have had massive pullbacks on every bullish move we've made. We've had these big pullbacks and we get a nice run. We get a big pullback, we get a nice run. A little bit smaller of a pullback, but still a decent pullback. We get a nice run. We get a really nice pullback. We get a good run. Now we get another pullback. So, and we pierced through where that low had gone. Is that important? The answer is yes. What did we do? We chipped away at the ice again. Yet one more day, we broke away at another level. So the bears are saying, hey, traders, if you want, we started the hole for you. We broke through the ice. All you got to do is push and you'll get right through there, right? And we see that move to the downside. So does that mean panic and selling in the streets? It might mean some will panic and there might be some selling in the streets. But the question you've got to ask yourself is, what would be my trigger point to say, I'm out? I'm out, or I'm switching over to bearish patterns, right? One of the biggest things that I focus on when it comes to my technical trading is not only Fibonacci, but the use of moving averages along with it. So if I look at, let's see. If I look here at Netflix, right? Here's where they did their 10-for-1 split. Huge mistake in my opinion. That was way too big of a split for them to do at one time. To lower their price to about $100 was just a mistake. We've been waiting for it to get to 82 and bounce. At some conversations we've held about going long at that point with a strategy that I teach on how to buy positions after splits with up to 5 entry points. And when you look at what's going on with Netflix, they're in what I call a bearish bias. They're what I call a true bearish bias. What does that mean? I have 3 moving averages that are primaries. There's a fourth one up here, which is an 5 moving average. That's only used for a specific trade setup. Hence, it's very faint. It's right here. It's very faint on our chart. It's only used for a very specific setup on a swing trade, which we're really not doing a lot of swing trades right now. So I have got 3 moving averages, and you can see what they are right here. I've got them labeled. The pink is the 8, the green is the 21, and the brown is the 55. They're all exponential. Now, the 8 and the 21 are my primary. The 55 is more of a secondary. It's more of an overall confirmation of what's going on in the market. I think I talked about this on one of the other trainings. I went back and tested 4.5 million days of moving average crossovers to determine what the best crossover settings were, and 8 and 21 are what came up to be the best settings. Ironically, they happen to be Fibonacci levels that we're looking at there, right? So we're what is in right now called a true bearish bias. Bearish meaning all the moving averages are in the correct order for a bearish pattern. The highest level, the biggest number, 55, is on the top. Again, don't worry about the 5. We don't care about that, right? The 21 is the green. That's in the middle, and the 8 is on the bottom. So all 3 moving averages are in the right direction. Great. Now what? Well, now that we see that we've got all of these in their correct direction, that gives us a bearish bias if we're down below there, right? True bearish bias means they're all in the right order. Just being down below the 8, if the 21 and the 55 were mixed up, that's not a true bearish bias. It's bearish, but it's not true. It's a stronger indication when the moving averages are all set up properly. And it works the same for anything that is bullish, which we don't have a whole lot of right now, but let's see. Not anymore, right? Let's see. Nope, not over the last couple of days. Eli Lilly was before today, right? Let's see. Okay. So Eli Lilly, if we look here, this is a bullish bias, and it is a true bullish bias. We get down to where we were yesterday, and the 21 was higher than the 55. So are we bullish? Yes, we're bullish. Is it true bull? No. Does that mean we don't take trades? No, it just means we're more cautious. If all the moving averages are in the right order, think of it as the stars aligning. If the stars are aligned, then I will go ahead and consider taking a full allotment of that trade. What does that mean? Well, you've got to determine, and hopefully you've got it already, but you've got to determine how much are you willing to put into a trade. So let's say that you have a $5,000 account, and I'm making this up. It really doesn't matter. You're going to look to do somewhere between 3 to 5 equal dollar trades. So $1,500 to $1,000 per trade. Whatever it is, you're going to pick one. You're not saying this one is $1,500, this one is $2,000. Pick a number. Okay? You're going to go over it a little bit, under a little bit. That's okay, but pick a number. Let's say for argument's sake, just because I can do the math really well, you do 5. That means every trade you're going to do for a normal trade would be $1,000 invested in that trade. And of course, we're talking options trade, right? You could do this with stock, but a little bit harder to buy, $1,000 stock, $1,100 stock if you're using $1,000 of cash. But you can buy the options with it. Okay? So we're going to look to buy on a normal trade. We're going to look to invest $1,000 into our options, calls, puts, whatever it is, $1,000. But if we are not in a true bullish bias or a true bearish bias, meaning we're anywhere else, and there are 3 other biases besides bull and bear. There's neutral, bullish neutral, and bearish neutral. And we'll have a training where we just focus on that one day. Right now, we are in a bullish bias, but we're not true bull. So I would take this as what I would call an aggressive entry. And I would do that at somewhere between, oops, I did not mean to clear that off. Sorry about that. I would do that one more time. Give me the drawing tools. There we go. I would do that trade. So if we had 1K going into the trade, for where we are right now, I would be 40 to 60% of the full allotment. So $400 to $600 is what I would put into that trade. You're going to have to make the decision for your risk profile, what fits best for you. This number, $1,000, 40 to 60, that's not going to work for everybody. Some of you are going to be saying, Rob, you're out of your mind. You must have flipped your gourd to think that I'm willing to put $1,000 into one trade at one time. One time, we put $1,000. I will never put more than $400. That's fine. You make the adjustments for you, but that's why it's important to understand your risk profile. That's why it's important to understand your risk tolerance. What are you willing to accept? What can you take on? How much drawdown can you afford? And when I say afford, you got a $5,000 account. If the market drops $1,000, it's not that you can't afford it. You may not like it, but you've got the cash there to cover it. You could still trade another day. But the question is, do you want that? Or are you willing to accept that? Or if we get down to where it's down more than $200, are you now in panic mode and your entire life is consumed by what that individual stock is doing right now? Right? So you make the adjustments based on that, which is why you start off in a non-funded trading account and you don't put real money into the trade to start. This way you get your feet wet, you learn exactly what you should be doing, right? And you're doing it in a non-funded environment. Stop the practice trading word. Words have meaning. They have value to them. And the value behind practice trading is nothing. You're practicing it, which means it doesn't count. No. Non-funded trades just means the color of the paper is different. It is exactly a trade that counts. Every trade should count. Every trade. Treat them all as if they were real trades. There's none of this, well, I'll wait one more day. Let's just see what happens. Hey, it worked. Yeah, you're not doing that with real money. So don't do it with your non-funded trades either. Okay? So you would look at potentially saying, all right, because if this was as of yesterday, because of where the moving averages are and how we're set up, I'm not going to take a full allotment on my trade. Now, you'll make, again, that final decision. Today, we gapped down. We had a good push down. We actually gave it all back from the earnings and then some from that gap. We went back. Well, actually, we gapped from here. So this is our closing price the previous day. So we didn't get that far down. But we've given the majority of it back. We've more than filled half of our gap on the way down. So overall, I literally taken a little bit of a bat today. They were my number one on my list today. They were down $85, $86 when I checked just before we got started here. That's about where we were at the time. Right now, they're down 77. So they've come back a little bit from where they were. Okay. So when we look at the S&P again, all of this to say there's a black line on my chart that my guess is very few, if any of you, have any understanding what this line right here at 67, 65 represents. Very few people will understand it. Very few people will ever get it. And I mean ever get it. Right? Let's see if I can go here. Doesn't want to give it to me. Oh, Microsoft did an update. Okay. So if you look, Fibonacci numbers start off with adding the two numbers before them together. So if you have the number 1 and the number 2, those are both Fibonacci numbers. If we do a simple, and I know this is an old formula, it's just the one that I know. This, or one I'm used to, I should say, plus this, it gives us 3. That's our next Fibonacci number. If we copy that to the next field, it's going to add 3 plus 2 gives us 5. The next one will add 3 plus 5, and that gives us 8, and so on and so on and so forth. If we extrapolate this out, these are Fibonacci levels. This is your number counting exercise that you learned in the 3rd grade or 2nd grade or whatever it was, right? It was a number counting exercise. And if we look at this, right? And we say, okay, what is this representing? Each one of these is add up 233 and 377, it gives you 610. Add up 610 and 377, it gives you 987. And you keep doing that, and then you get to the number 6,765. Well, that's the black line that's on my chart right there. You see if I hover over it, 67.65. There's other ones down here. Actually, this is in the previous window. If we scrunch down a little bit, this is a midpoint. And if we really scrunch down, there we go. 4181 is the next one that's down there, right? 4181. That's our next, what are called super fibs. This is a critical level in the market. When you look at Fibonacci, and yes, I talk about it a lot. It is my number one indicator. In my opinion, there is no better indicator in the market. Doesn't mean it works for everybody. Doesn't mean everybody uses it the same way, right? I know by looking at everything else in the universe exactly how things work, because when you see it in human nature, when you see it in art, science, math, music, medicine, your own DNA is made up of a perfect 0.618 and 1.618 Fibonacci level for the minor and the major DNA, your major and your minor. They're perfect Fibonacci levels. That is a key level, 0.618, right? So it's the most important number in the world to a Fibonacci trader, but to anybody, even if you don't realize it. This level is a psychological level that stocks tend to hesitate at, and traders have absolutely no understanding why. And if you go back and look at the 67.65 and 41.81, draw a line on your S&P 500 chart at 41.81. Go back and look at it and see what's going on there and determine, from that, if that line had any value or not. And you will see it. If we press in here, you can see the very first time when we hit, by the way, an all-time high, we went right up to it. How far up to it? Well, our high this day was 67.6458, and 67.65 is the fib line. So we're talking about 64.58 to 65. So 42 cents away from that. We stretched back towards it again, and we failed. We came back up, and we finally gapped through it. When we did, we came back down. We closed right there. We bounced off of it. Yeah, we broke through here. We gapped up. We bounced off it again. We broke through. We retested it 1 day, 2 days, 3 days, 4 days before we broke above. We came back to it again here and here. The middle day kind of just pierced through, broke through, right? But now we're potentially back at it again. So if we start to see that we're coming back to that level again, what do? We've got to make a plan. If we bounce off of that level, off of that 67.65, then what? What's next if we bounce? Right? That's the first question to ask yourself. If it bounces off of there, what am I doing? Well, right now, I'm in a bearish bias. It's not true bear, but it's bearish. So if you focus on that, on average, 70 to 80%, 70 to 80% of all stocks tend to move in the direction of the S&P 500. Well, knowing that, if the S&P is down today, your stock is still in a bearish bias, why would you even consider taking a bullish entry? You should only be trading as a newer trader in the direction of the overall market. What that will do is it'll prevent you from using your head to make the decisions of, I know better because I think it's going to go up from here, even though there's no clear and conscious reason for it. When I've seen stocks go from $100 down to 20, 25, and students come up to me at live events and go, Rob, I think it's time to buy the stock. Really, let's take a look at it. And we pull a chart up and I put it on the overhead in our room. And the stock has done this for the last 9 months. And that's where it sits right now. And it's gone from $100 down to, let's say, $20. Just easy math, right? $20 right now. I think this is it. Is there a historical level here? No, but it's going to bounce from here. I know it. How? Well, it just feels like it's going to bounce from here. Well, it might, and you might be right. But I have no technical reason to take that trade. Why would I jump on board something that I have no understanding, right, wrong, or indifferent of if it's going to work or not? I just don't. I don't know what's going on with it. So why would I want to put myself at that kind of risk? I don't. I won't. Until I see the bounce, and the bounce comes off a key level. If we go back to Netflix for a second. Let's try that again. All right. We go back to Netflix for a second. And from where we split, we had this move down on our fib all the way down to here. We got a bounce. We rolled over. But I had been looking at this 82 level as a potential bounce point for Netflix. And we got it right here. So we came down almost to the penny. Now, by the way, this 82, I've been talking about this from right after the split. The split itself was on 11/17. So the end of November, beginning of December, I've been talking about looking at that 82 as a bounce point. How did I determine the 82? I went back technically and looked at historical levels and found this 82.20 right here. Here was a critical bounce point, and then this was the catalyst that drove it to the all-time high, which was over 1,300 points before the split, before the 10-for-1 split. Well, we have nothing else historically that high. We're just not up to that level. Okay. So then we would go back and look at the next level. We've got some support here. We look at the next level. We've got it all in here and here. So every one of these are based on historical levels. We got a bounce. We came from 82 up to 86. Hopefully some took advantage of that. They were able to capitalize on that short-term move. Again, I use it for long-term for buying stock, anticipating that the first 1 or 2 times I buy the stock, I may get a continuation down. But I do this with a methodical method of where I enter that trade, which is finding the key level and getting the bounce. If I can get that to enter, that's where the position is taken on. And if you just do 20% of your overall investment, it means you got 4 more times you're going to enter this. So if you want to buy, let's just say 50 shares, you buy 10 shares each time. Well, but more commissions, Rob. Commissions are cost of doing business. Don't let commissions bother you. Right? There's plenty of great commissions out there. Tradia's got an amazing commission structure with their first level plan. So there's no reason to let commissions get in your way. If you can get it for just over $100 a year on your commissions, you're killing it. Understand, my very first options trade in 1997 was with Merrill Lynch. I bought 10 contracts of an option. I had to call a broker on the phone. I told them what I wanted to do. They had to send it to a floor, wait 2 hours to determine if I was filled or not. Couldn't even get out because didn't even know if I was in. 2 hours to determine if I was in or not, and they charged me $200 for 10 contracts. And then, of course, that same $200 on the way out. Now, I ultimately found a broker that was cheaper, but we're still talking about much higher commissions than what we deal with today. Commissions are ancillary. They are not the major factor here. If you're looking at a bearish setup here, and if you're looking at a short-term trade, I don't care about a bounce. This bounce right in here, if you're going to take this, you better have a defined exit. And for me, it was intraday, a defined exit where I'm out. It hit the 82, came to 86. We're done. Resistance is our ceiling. You want to be out just below resistance, right? When it fails and it retests and rolls over, if we get this rollover here, I'm looking at this heading down to 77. Look to buy a put. 77.20 is our next downside target. But that's support. That's not where we're actually leveling or going after. Saying, right, that 77.20 is what we're going to set our target at. It's not. That's support. I don't expect it to get there. I'm going to give it a little wiggle room. There's an expression, if you know, you know, right? And the expression is don't glean the fields. What? Just look at it this way. If you know what it means, you know. But when you go through a field of fruit, vegetables, whatever, don't wipe it out. Leave some for the next traveler coming through. That's basically what it means, right? Don't try to get the last penny of the trade. You never will. You're never going to get the very lowest low when you place the trade to get into it and the highest high when you go to get out of it. In the tens of thousands of trades I've done, it's happened one time to me, and it was pure dumb luck. Nothing at all to do with me picking it or not. I had this conversation with a friend of mine who's a very good trader who had never thought of it that way, that he's just trying to get in at his best price. He's never looked at it as, do I get in at the absolute best and get out at the absolute best opportunity? And he came back and said, Rob, I went back and looked at my last 2 years, and there's not one of them that I have done a trade that I've gotten in at the lowest low and out at the highest high. Not one. Just hasn't happened for me. Me either. Me either. Again, one time out of all those trades it happened, and it was on an energy stock. Just happened to be that I pulled the trigger right as the market rolled over for no other reason than we hit my target. It wasn't I had some inside information or I knew better or, oh, look at me, the guru. Hell no. I'm going to use that chart and make every determination off of what's going on with that chart. None of this, and I mean none of this, is my gut, right? Because if it's up to my gut, we're just going to eat chocolate all day long, all right? Dark chocolate, but chocolate, okay? No. You've got this 67, 65 level right here. That is a key level. If we violate that, there's a blue zone, I call it, which has this 67, 57, 58, we'll call it level. They're close enough together that we look at it as a zone that we stretch down into. See here, we stretched into the zone. We stretched into the zone. We pierced it on this day. We broke it. We didn't pierce it. We just smashed it on this day, right? But this level gives us the opportunity to have two lines that are close enough to each other that we call them one line. So we're not trying to pick which one is stronger, which one is more important. The one on top, The black line, the 67.65, this one here, it's more important. You know why? Because we're coming from that direction. If we were coming up, the 67.58 would be the most important line because it's first. But together as a zone, if we break into there, it tells me something about, right? The bears pushed down and they came into this level, but they couldn't contain it. They moved up. We gapped down the next day. We actually opened flat. We ran down the next day. We gapped up the day after. We ran up, pulled back. We got a higher low in here. We got a higher close. But that higher low, lower low, higher low gives me a swing bottom, gives me a swing low. And we got our bounce on that was our catalyst. Here's our swing low. It's our catalyst. Our swing low is our catalyst, right? So that's what we're looking at there. So when you go tomorrow and you're looking for a chart as a potential trade setup, if I'm closing right now at 268, pretend it's the end of the day, 269, we'll say, we're at 270.32. We're close. So if you are if you're not an experienced trader, then I would look at this as only one direction trade, and that would be bearish. If we break through tomorrow, retest and fail, consider taking the trade. Set a target just above the support level at the bottom and your stop just on the other side of resistance. That's the only trade. If you're an aggressive trader or you are a trader that has experience in the market, and tomorrow the S&P 500 is up, right? We make a move to the upside tomorrow, and so let's say we come back and retest and we bounce off of there, and you want to take that trade. I think it changed from a line to from a pen to a line, right? So you want to take that trade right in there. This is going to be my resistance. My target's going to be just down below. My stop's going to be somewhere down here, right? But it's a day trade. If you're going against it, if this is the S&P and this is me, you want this to be a day trade. You do not want this to linger on overnight, holding on to this, hoping and praying that it comes back. Hope and prayer do not work in the market, folks. I'm telling you. Half the market's praying for it to go up, half the market's praying for it to go down so they could buy it, right? Stop fighting on that and focus on what the chart is actually doing. And with that, ladies and gentlemen, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it. And remember, you're just one trade away. I will see you all at our next update next week. Take care, everyone. See you soon. Bye for now.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.